Welcome to Managing Risks and Returns lecture. Bank managers must balance banking risks and returns because there is a fundamental trade-off between profitability, liquidity, asset quality, market risk, and solvency. Decisions that increase banking risk must offer above-average profits. The more liquid a bank is, and the more equity capital used to fund operations, the less profitable is a bank. Ceteris paribus, of course. Banks face 6 basic types of risk in a day-to-day operations: credit risk, liquidity risk, market risk, operational risk, reputation risk, and legal risk. Market risk encompasses interest rate risk, foreign exchange risk, and price risk. Each type of risk refers to the potential variation in a bank's net income or market value of stockholders' equity resulting from problems that affect that part of the bank activities. Banks also face risks in the areas of balance sheet activities, which create contingent liabilities. In general, promised or expected returns should be higher for banks that assume increased risk. There should also be greater volatility in returns over time. Potential variation in net income from loan non-payment or deferred payment is called the credit risk. The formula or the ratio can be calculated by as gross losses minus recoveries. Please keep in mind that high risk is associated with higher ratio and low risk is associated with low ratio of net losses. High risk manifests itself in occasional high charge-offs, which requires above average provisions for loan and losses to replenish the loan loss revenue. Thus, net income is volatile over time. Expected future losses come from past due loans that are still accruing interest. Non-performing loans are more than 90 days past due. Non-accrual loans are not currently accruing interest. Restructured loans have modified payments or interest. Classified loans have reserves for recognized losses. How can a bank prepare for losses? Ideally, loan loss reserve should equal non-current loans. High-performance banks generally benefit from lower interest and non-interest expense and limit credit risk so that loan losses are relatively low. They also operate with above-average stockholders' equity. Liquidity risk. It is the risk to earnings and equity from the bank's inability to timely meet payments or obligations. Funding liquidity risk is the inability to liquidate assets or raise required funding. Market liquidity risk is the inability of the institution to easily unwind or offset specific exposures without significant losses from inadequate market debt or market disturbances. Liquid assets are costly to hold because they pay very low interest. Banks attempt to minimize cash holdings due to the cost of holding. Liquid assets consist of unpledged, marketable short-term securities classified as available for sale plus federal funds sold and securities purchased under agreement to resell. Banks with large amounts of funding from core deposits have better liquidity than banks without them. The formula is core deposits divided by assets. In this case, high risk associated with low ratio and low risk is associated with high ratio. High risk manifests itself in less stable funding as a bank relies on more non-core purchase liabilities that fluctuate over time. These non-core liabilities are also higher cost, which raises interest expense. Market risk. Risk to earnings and equity from adverse movements in market rates or prices. Interest rate risk is the potential variability in an institution's net interest income and market value of equity due to changes in market interest rates. It is analyzed using gap and earning sensitivity analysis. More comprehensive approach uses duration gap and economic value of equity sensitivity analysis. An asset or liability is rate sensitive if management expects it to be repriced within a certain time period. Equity and security price risk is the potential risk of loss associated with trading account portfolios. Large banks often conduct value at risk analysis to assess risk. Small banks conduct sensitivity analysis to do that. Foreign exchange risk is the risk to an institution from adverse movements in foreign exchange rates. Most banks measure this risk by calculating measures of net exposure by each currency. Net exposure is the amount of asset minus the amount of liabilities denominated in the same currency. Market risk in the form of interest rate risk is or can be found by repricable assets minus repricable liabilities divided by assets. High ratio is associated with high risk. Also, low risk is associated with low ratio. High risk banks do not closely match the amount of repricable assets and repricable liabilities. Large differences suggest that net interest income may vary sharply over time as the level of interest rates changes. Market risk in the form of foreign exchange risk is assets denominated in a foreign currency minus liabilities denominated in the same foreign currency. If there's a high risk, high risk is associated with a large difference. On the other hand, low risk is associated with a small difference. High risk manifests itself when exchange rates change adversely in the value of the bank's net position of assets versus liabilities denominated in a currency changes sharply. Operational risk is the possibility that operating expenses might vary significantly from what was expected. It may occur as the result of business interruptions, transaction processing, inadequate information systems, breaches in internal controls, and client liability. It can be calculated as total assets divided by number of employees. With this ratio, high risk is associated with low ratio and low risk associated with high ratio. High risk manifests itself when the bank operates at low productivity, measured by more employees per amount of assets. Finally, the legal and reputation risk. Both reputational risk and legal risk are difficult to measure beforehand. It is more observable by announced problems and issues.